Today, the most heavily shorted ETFs in the market are soaring. What's an ETF? What does heavily shorted mean? We got all that and much more on today's show. Hey there, Stacker. Welcome to Money in the Morning, the show where we go over a headline ripped from the financial press. And today we're talking all about heavily shorted ETFs. We're not only going to read the piece, this one from CNBC, we're also going to talk about it and exactly what it means for your wallet. That's what we do every day here at Money in the Morning. Well, I'm super excited to get this thing going today. We've got a fantastic discussion on ETFs. And if you're like me, you might have always wondered what it means to short a stock. We're going to also explain that to you. So, Laura, get this party started.
It's that time again. Your Money in the Morning headlines.
We do the show live in front of a Facebook audience, and Kathy's here with us today. Good morning, Kathy. Kathy says it's too early for me today. Maybe it is, but that doesn't stop me. We're going to see if we can make this an incredible mess-up fest as we go through this. Actually, I don't think we will because it's going to be fun. I've got some really fun headlines for us today. And let's start with this one from CNBC. This is something people aren't talking about enough. I feel like I keep seeing these smart people in the media talk about this, and I don't hear the online forums talking about it yet. And I wonder why. I wonder where the disconnect is. But let's dive into what the hell I'm talking about instead of all this foreshadowing, shall we? This is written by Lizzie Gertis at CNBC. The most heavily shorted exchange-traded funds in the market are soaring. On these bets, short sellers could come up well short. The most heavily shorted exchange-traded funds in the stock market seem to be likely targets for Wall Street skeptics or those who try to make money by betting that stocks will go lower. Let's talk about how that works before we dive too far into this, because if you've ever heard of this idea of selling short, you might be like I was at one point going, I don't know what that means. I have no idea. I know in general, it means that if the shares go down, I make money. But how does that actually work? Like, what is that? What's the mechanism? How do I make money when shares go down? Don't I just buy a stock? Here's how short selling works. I take shares that I don't own and I loan them to you, hoping the whole time that you own them, that they go down in value, at which point I buy them back and I hand them back to the owner. Bam! That's a lot there, isn't it? So first of all, I'm borrowing somebody else's shares. I don't have my own shares. I'm borrowing somebody else's shares. I take those shares and I loan them to you. And when I loan them to you, I'm hoping they go down in value because I owe this person X amount of money back. So I take these shares and in essence, I buy those shares and I loan them to you. So let's say that they're worth $100 when I take those shares, grab them, and I loan them to you. If they're worth $100, what do I want to have when I got to give the shares back? I want to be able to keep some money. So I want to be able to give that money back. I want to give less money back. So I then take those shares back from you, hopefully at a lower price, and I give you back less cash than I started with. That's the way that shorting stocks works. I'd always wondered that. I had no idea how it worked. And then when I became a financial planner, obviously having to get licenses and all that stuff, I remember being absolutely thrilled that I knew how that worked. And now you're thrilled too, I'm sure, to see how that works. But so shorting shares means you're hoping that they go down, right? You're betting money that they go down. And what happens if they don't go down? If they don't go down, you're sitting on a heater. Imagine I take this money and I buy some shares, I loan it to you, the shares go up in value, I could lose a ton of money. Like I could lose an unlimited amount of money. Those shares could go sky high and I could be on the fence for a ton of money. And that's why shorting shares, by the way, a lot more risky than just buying what they call long. So there's long and short. Short, we just defined. Long means I just buy the shares and I hope it goes up. How much money can I lose if I go long? I can only lose the money I invested. If I buy shares in whatever company, Best Buy, and Best Buy goes to zero, I only lose the money I invest in Best Buy. If I short Best Buy and it goes to the moon, it can just keep going up and up and up, and I keep losing more and more and more money. Just absolutely can be ugly. So when we look at short sellers right now, what this piece is saying, short sellers feeling some heat in these positions because they bet money that these stocks are going to go lower. Okay, let's jump back into it. They include, these are the exchange traded funds that they've bet are going to go down. The Spider S&P Retail ETF, a collection of 94 key retail stocks that's currently sold 525% short, meaning 525% more people short than long, 5 times more people short than long. The Van Eck Vector Semiconductor ETF, a 25 stock fund tracking the world's top chip makers, it sold 140% short. And the Spider S&P Oil and Gas Exploration and Production ETF, which holds 64 drilling and refining stocks, that sold 117% short. Yet, these funds are also soaring. Year to date, the retail ETF is up nearly 11%. The semiconductor ETF made a fresh 52-week high on Monday and has gained almost 30% as of the time we record this. And the oil ETF has climbed more than 20%. How is this possible? Some, like Advisor Investments Chairman Dan Weiner, attribute the contradictory action to low trading volumes in the broader stock market. Last week, the New York Stock Exchange saw its lowest volume since December. This market has either reached new highs or almost has reached new highs. And yet, there's very low volume. Weiner said Monday on CNBC's ETF Edge, people seem to be a little bit more bearish. They're certainly not running with the bulls and buying with abandon. You have a big short position. It means somebody's hedging or a lot of somebody's are hedging. Stop there for a second because I want to define this also. Because to me, this is super interesting. So these stocks are up on low volume. These people aren't shorting the stock. They're shorting the exchange traded fund, which is a basket which represents all of the stocks in that position. So if we're talking about retail as an example, it's how many did I say 64? 64 different companies. Just had that. 64. Nope. That's the oil and gas exploration and production. 94 for retail. So we'll take this first one, retail. 94 stocks in this retail position. They're betting that the ETF is going to go down, but the individual stocks inside of that ETF keep going up because they keep announcing that things are going well, that the stocks are going well, the stock market overall doing okay. So these stocks keep going up and people who are shorting them continue to lose money, but they're going up on low volume. Now, volume is the number of people trading in the stock market. There haven't been a lot of traders lately. And so we're seeing a lot of people either on the sidelines with cash. We've talked about that before, or they're going short. And when you go short, what are you betting? You're betting it's going to go down. So if you're in cash, which is a ton of people, you're betting what? That you think the stock market's not going to do anything good at the very least, that your money's better off being in a safe spot. And if you're short, you're betting that the market's going to actually go the wrong way. And yet it continues going well for these positions. On with the piece. That could explain the rise of the retail ETF, also known as the XRT, whose 525% short position could be a result of bearish options trading and securities lending. ETFtrends.com editor and proprietor Tom Lydon said the same in an interview. Big box retailers are getting unloved in a big way, Lydon said, adding that fortunately earnings are good so far this quarter. We're going to continue to see more of this, especially as this market gets higher. The question is, can these companies continue to bring profitability? And if they do, by the way, continue to bring profitability, what are you going to see? you're going to see these stocks continue to go higher. What are we learning from this? Let's get to the takeaway. What's the big lesson here? I think the big lesson is if you're short stocks specifically because you think this market's going to go down sometime soon, what we've seen, not just from this piece, but from other pieces, there's so much money on the sideline and the market continues to kind of wistfully move upward that at some point the market can outlast you. And there are actually analysts. I had another piece I thought about talking about today. There are analysts out there who think that the stock market actually is going to go higher as money's forced back in, meaning you get sick of waiting. You get sick of waiting around with your money in cash. Like, hell, I got to get back in. You get back in. What does that do? You're a buyer. You're buying the stock. Stock goes up. More people buy. More sellers, stock goes down. More buyers, stock goes up. On the other side, though, there's even more pressure on these shorts. Because imagine if you're in the sideline, okay, maybe you can wait a longer period of time. Maybe you don't have to sit, or maybe you can continue to sit, by the way. You don't have to sit, but maybe you can continue to sit. But if you're short, you're losing your shorts every day that the market just continues to go higher. Those are the people sweating. And you look at the huge amounts of money. I mean, 525% short. 100 and something percent short, the VanEck Vector Semiconductor, 140% short, 117% short for the Spider S&P oil and gas exploration and production. Those people are sweating. Every day the market goes up, they're losing their butt, and they lose it more and more and more. They get forced in, and as they're forced to finally get rid of their short position, you know what that essentially does? You're buying the stocks, right? You borrow the money. I sell them to you. I give the money back. We buy the stock back. The key point there is we buy the stock back. More buyers, stock goes up. There's a thing, by the way, when a company goes bankrupt, it's a horrible term, by the way, but it's called a dead cat bounce. And I hate that term. It is a rotten term. But the reason why they call it that is because of the fact that when the company's dead and it gets almost all the way to dead, company's already declared bankruptcy, you know they're going out of business, the stock will go almost all the way down, and then it'll pump back up. And I've seen so many people get caught in the, excuse my phrase again, dead cat bounce. So many people get caught there. They go, look, I told you it wouldn't completely go under. There's people buying it. Nope, that's not what's happening at all. All the shorts are ringing the cash register. They're giving their shares back and they're cashing it in for tons of money. That's the way that the short market works. But we're not seeing enough about this, and this could send this market even higher. But what else does it symbol? What else does it signal? There's a lot of people expecting this thing to be over, expecting that this long ride, the numbers just keep going higher and higher and higher, and people just keep getting beat and beat and beat. Maybe we are nearing the end. But I think it is interesting. You play poker, and this is our takeaway from piece number one, guys. You play poker, the market has more chips than you have. You know how you're sitting with somebody and you got this awesome hand? You think you have an awesome hand? Market's got to go down soon. It's got to go down soon. The market's sitting across the table from you with way more chips than you have. And it will disappoint you every single time. And by disappoint, I don't mean disappoint is a euphemism for it will take all your chips. And even more. I wouldn't play that game. Let's spend a second saying hi to our friends hanging out with us here on Facebook. Very, very, very chatty group this morning. We've got Michelle here. Hey, Michelle. Kathy's here. Kathy says she learned something this morning. Excellent. Glenn is here. Hey, Glenn. Karen's here. Susan's here. Jim is here. Nice group of people with us hanging out today. Donna's here. But let's start with this from Lori. Lori says, interesting. I keep hearing people talk about how horrible the economy is, and I wonder what they're talking about. Can't help but wonder if they're making that statement based on politics or actual economic knowledge. You know, it's funny because to your point, Lori, bam, the economy does keep showing positive numbers. And there are plenty of people who don't want it to be that way for whatever reason or say that it's not that way. Now, I will say this, there are sectors where the market, even though the economy is good, there are things that I worry about. Manufacturing jobs, not nearly what we'd hope that they would be, as an example. A lot of new positions being added in the service workforce, part-time work. I worry about that. I worry about wage growth. So there are things that are worrisome, but when you look at economic numbers as a whole, things are cranking. Employment numbers in general, if you get rid of what I just said about where those jobs are being added, fantastic numbers. Some good stuff there. James says the market can stay irrational longer than you can stay solvent. Can't remember who said that. You just did, James. That's who said it. You just did. Own it, big guy. Jim says the country's very big in different parts of different economies. Ask a soybean farmer, and he or she will have a different take on the economy than a 20-something working in a startup in San Francisco. So true. It all is based on very, very different criteria. The huge economic numbers look great. You can always, I think, in any economy, to Jim's point here, you can always count on different parts of the economy to be lagging, right? Some parts are going to lag others. Good stuff.
This show is created by Joe Saul-Sehy, hosted and produced by Bobby Rebell and Joe Saul-Sehy, is engineered by Caden Thompson, and all put together by a pack of well-trained ferrets down here in Joe's mom's basement. You'll find Bobby at the Financial Grown-Up Podcast and Joe at the Stacking Benjamin Show. Go say hi to them there, too. Online, visit us on Twitter at Average Joe Money and at Bobby Rebell, or come join a live recording at our Facebook page. That's facebook.com/iStackBenjamins. I know you already know this too, but Money in the Morning is for entertainment purposes only. You should not act on anything recommended by a bunch of entertainers in a basement or even a Manhattan kitchen without first consulting your financial advisor. And second, dude, have your head examined. Have headlines you'd like us to discuss? Send them to joe@stackingbenjamins.com or put them on our Stacking Benjamins closed Facebook group. This show is a collaboration of Stacking Benjamins LLC and BRK Media LLC. Copyright 2019. All rights reserved. I'm Joe's mom's neighbor Doug, and I reserve the right to always say, we'll see you next time back here on Money in the Morning.